The sign of a good decision is not that it turns out to be right. This is counterintuitive. I believe that most of the things that are important in the investing world are counterintuitive. But the point is, you can make a good decision and it doesn't work. Because number one, nobody knows everything when they make the decision. Nobody has all the facts. And number two, the world is dominated by uncertainty and by randomness. You can make a perfectly good decision with good data and a good decision process, but it turns out not to work because of some random event. If you read Fooled by Randomness by Nassim Taleb, a great book in my opinion, he said to understand the quality of a decision, you have to understand not only the events that occurred, but the other events that could have occurred but didn't, what he calls alternative histories. And only when you consider all the possible outcomes from a decision do you really understand the quality of that decision. It's really important to understand this and to understand that there are lots of good decisions that don't work, and there are lots of bad decisions that work. We all know about people who were right for the wrong reason. So only when we look at the world that way do we understand who really made good decisions or not. You can't make a good decision every day. These calls of a peak or a trough at the extreme of bubble and crash or high and low, bull and bear, the decisions, the logic is clear and I think compelling, and the probabilities are on your side. The probability of being right is high. But if you do it in between, you try to do it every day or every week or every month, you try to do it when the market is 2% overvalued or 4% undervalued or something, it's very hard to be right. And one of the most important things is to invest as it's right for you. And, for a chicken, try to be aggressive, or for a cowboy to try to be conservative is challenging. I talked about the fact that liquidity isn't always a great thing, and selling and buying too much and trading too much is not a good thing. If you look at the chart of a stock that's been up for 25 years and you say, man, I wish I had that stock, think of all the days you would have had to talk yourself out of selling. And it's true. I mean, the hardest thing in the world is to hold a stock for 25 years and have it see it go from 1 to 10 to 100 to 1,000 and not sell it, and then watch it go to 10,000 and 100,000. And that's how you make the big money. But you have to hold for a long time. Instead, most people sell. In fixed income, there's no such thing as a huge success because returns are asymmetric. You can't make much, but you can lose a lot. So if you're in a market where you can't make much, but you can lose a lot, then by definition, your approach has to be asymmetrical because the possibilities are asymmetrical. Graham and Dodd in the Bible, Security Analysis, in 1940, called fixed income investing a negative art. You succeed not because of what you buy, but because of what you exclude from a fixed income portfolio. So the point is, to hit the big successes, you have to hold for the long term. The first of the great adages that I remember learning was that being too far ahead of your time is undistinguishable from being wrong. People turn negative because they see things in the environment that are going on that spook them. And you may be, in principle, right. But if you do it too soon and it doesn't work for a few years, everybody says, look at that guy. He used to understand this process, but look how wrong he is. Now, you're not wrong. You're right, but early. But right early looks like being wrong. And the question is, can you survive in that interim between when you make the decision and when it's proved out? And these can be very difficult times, and you can show terrible performance and lose most of your money under management, even with a decision which is right in principle. The necessary condition for outperformance of others is to do something different. Not every day, because there's not something intelligent to do differently every day, but to be aware of excesses in the environment, and be they extremes of the economic cycle or extremes of the market or of investor behavior at that time, to stand away from the herd. I think the only thing you can really do intentionally is be aware and try to, as I say, not conform. Emotional control, unemotionality, is essential, because if you are subject to the same emotions as the herd, then you'll probably do the same things as the herd, not stand away. So by definition, then, you have to not be emotional like the herd. People always ask me, well, how do you be unemotional? It helps to be born unemotional. And most of the great investors I know are unemotional or have their emotions under control. But that seems harder to me. It seems harder to recognize the importance of emotional control and practice it, given that we're all subject to the same inputs, and seems to me to be harder to practice emotional control rather than be unemotional by nature. The reason markets go to extreme is that many people fail to say, oh, it's one of those. Instead, what they say is, this time it's different. I first came across that phrase on October 11th, 1987. There was an article in the New York Times written by a woman called Anise Wallace, and the title was something like, this time it's not any different. What she said is that when the market goes to extremes, people always say, oh, this time it's different. In other words, the old rules don't apply. This is such a unique experience that the old rules don't apply. And so the old valuation limitations, yes, the normal post-war PE is 16, but it's selling at 30 now, and that's fine because this time it's different. Whether it's the internet or the Nifty 50 or the housing miracle in 20056, this time it's different. The old rules don't apply. And then there's a correction and people say, oh yes, I guess the old rules do apply. So it's very important when you hear people say this time it's different, a red light should go on. I think the phrase came from Sir John Templeton, but he said, but sometimes it is different. 20% of the time, it really is different. And the world does change. And if that was true when he said it in the 80s, I think it's much more true today. Maybe it's 40% or 50%. When I was a kid or even a young man, the world felt like it was a static place. Nothing ever changed. I always say that when I was a kid, comic books were 10 cents through my whole childhood. We didn't have inflation. We didn't have change in prices. We didn't have rapid technological change or communications that changed everything so rapidly. And we didn't have the partisan communications that we have now. Communications operated under something called the fairness doctrine. So the world didn't change. And events played out in front of an unchanging backdrop, shall we say. Today, the world changes every day. So it's much more likely today that things really are different. So I think it's important to recognize that today and be more flexible in our approach. Mark Twain said, history doesn't repeat, but it rhymes. There are some things that are kind of eternal verities, but there is much more that's different from day to day. Here we are, you invested in the best companies in America in the end of the 60s, early 70s, and you lost almost all your money. Now I'm investing in the worst public companies in the world, and I'm making money safely and steadily. So I drew two conclusions. It's not what you buy, it's what you pay. There's nothing so good that it can't become overpriced and a bad idea. And there are a few things so bad that they can't be underpriced and a good idea. It's not what you buy, it's what you pay. And the corollary of that is that good investing is not a matter of buying good things, it's a matter of buying things well. And if you don't understand the difference between buying good things and buying things well, then you shouldn't be doing this. There are three stages to a bull market. The first stage, when very few people, only a gifted few, understand that there could be improvement. The second, when most people accept that improvement is actually taking place. And the third, when everybody believes that things can only get better forever. And it is which stage we're in and which feelings people are guided by that really determines the status of the market. So are people being too pessimistic in the first stage? That's when you get bargains. Or too optimistic in the third stage, which is when, the excesses on the upside are taking place and when you can really get killed if you participate. The real easy and big money in investing comes when you are willing to do something that nobody else will do. And when that's buy, nobody else is willing to buy, you get a bargain. The real easy way to lose money is when you do that everybody else is doing to excess, because clearly now there's too much optimism to be realistic, and you pay prices that vastly exceed the intrinsic value. And that's an easy time to lose money. Living life your way is the most important thing. This is how I conclude most of my talks with students on campus, because they always ask, well, what should I do? And I said, well, number one, there's no right answer for everybody. No one size fits all. The worst thing you can do is do what other people tell you to do, or emulate what other people are doing, or what's popular, or what society says you should do. And certainly you shouldn't choose a career because you can make the most money. I mean, for most people, that's not going to end up successful. You have to live your life your way. There was a time, believe it or not, when most people wanted to be accountants because it was a very profession in demand. Then there was a time when everybody wanted to be a consultant. And then in the 90s, and maybe even, I guess, in the aughts, everybody wanted to be an investment banker. And now everybody wants to be a venture capitalist and a techie. But I mean, obviously, what a terrible idea it is to choose your career because it's the one everybody else is choosing. Number one, it'll be crowded and competitive. And number two, it may not be satisfactory to you. So I always say to kids, your career you choose should play to your strengths and avoid your weaknesses. And it should be the thing that will make you the happiest. We only get one life, as far as I know. And what a mistake it is to squander it on something that doesn't play to your strength and make you happy, and something which is chosen just because it will make you the most money, unless that's the thing that'll make you happy. But I mean, that's my most important piece of advice, that the things that work the best are the things that are unconventional and correct. It's a little hard to be unconventional. Most people don't do it naturally. And the things that are conventional are often the right thing because they're the thing that so many people have thought about and chosen to do. So it's hard to be unconventional, and it's hard to be right when you're unconventionally. But when you do both, it's the most successful. There is no one most important thing. There are many things which are essential and you have to get right. And so that's why I use that format. In the memo, it talked about a good partnership, which is the most important thing. And I said in there that the most important thing in a partnership is shared values and complementary skills. And I think that if you work with people who have different values than you do, it's unlikely to be successful. If your skills are duplicative and you have the same strengths, then you probably have the same weaknesses. And the weaknesses can get you into trouble, and the strengths are duplicative. And what ends up happening is one person eventually says, well, I can do everything he does and more. I don't need him. And so he says, I want you to go cut your share. I need more. And that jeopardizes the organization. Risk cannot be quantified in advance. Risk is the probability of a bad outcome. You can't measure probabilities of uncertain events. There's no place you can look to measure the probability of a bad outcome. And you can't even figure out the probability of a loss after the fact. You can't tell whether something was risky after the fact. If you invest $100 and a year later you sell it for $200, was it risky? You can't tell. Why? Because the outcome that happened was only one of the outcomes that could have happened. We're back to Taleb and alternative histories. And so if many things could have happened but didn't, then you can't say what the real range of possibilities was. You can't say what the probability distribution governing that investment was. That is to say, you can't tell whether it was risky. One of my heroes was John Kenneth Galbraith, and he wrote a book called The Short History of Financial Euphoria, which I thought was very good, and one of the first ones that got me formally thinking about cycles, because what it was about some of the excesses of optimism that he had seen and some of the extreme bull markets. Peter Bernstein's book, Against the Gods, which discusses the origin of the science of probabilities. And it's only because of the creation of the science of probabilities that we can understand and risk and transfer risk. I mean, the insurance industry couldn't exist if there was no sense for the probabilities of bad things happening, which is what we transfer the risk of that to the insurance company by taking out car insurance and so forth. So Against the Gods was very important. And Devil Take the Hindmost by Edward Chancellor, which talked about things like the South Sea bubble and tulip bubble. That book was the inspiration for my memo, bubble.com, the first day of 2000, which talked about the excesses of the tech bubble. And that's the first one that got a response. And that's what put me on the map, because it was right quickly. Remember, I said, if you're right, but it takes 5 years, looks like you're wrong. This one was right away because I did it in 2000. And yeah, that was terrific.